Point of interest. What are point of interest? Point of interest are the areas in which you are looking to become interested in participating in the market if price gets there. Why are point of interest important? Point of interest are important because they will give low risk and high probability setups. They will also give you a logical and methodical way of entering the market while minimizing the amount of time you spend on the charts. How to spot a point of interest. All point of interest are order blocks, but not all order blocks are point of interest. The only point of interest you will be using are extreme and continuation order blocks. Refer back to extreme order blocks and continuation order blocks to see how they look. So to tie it kind of all back together, there are tons of order blocks everywhere on every single time frame. If you draw them all, your chart will be nothing but one big order block. So what I'm trying to say out of the first sentence is that all point of interest are order blocks. But just because something is an order block does not mean it is a point of interest. The only point of interest you will be using are extreme and continuation order blocks. So if it is not an extreme or a continuation order block, you should not use it as a point of interest. If you would like to also add breaker blocks and banker blocks, that is completely up to you. Those concepts are there for you to try out and see if they work for you. I personally would not recommend them, even though those types of order blocks do happen in the market and they can work. I highly recommend to only use the extreme and continuation order blocks. And obviously, if you need more examples, you can go back to those sections. Does that make sense?
Yeah.
Cool. Extreme order blocks. As stated in the extreme order blocks section, extreme order blocks have the highest success rate. The reason for this is because if your directional bias is correct, extreme order blocks should be the furthest price may go until this is worded weird again. Should be the furthest price may go until, I guess it's worded right too. It's weird. Let me start back. The reason for this is because if your directional bias is correct, the extreme order block should be the furthest price may go until going into its anticipated direction. So I kind of worded it weird, but ultimately, it's the furthest price may go, but while still maintaining your bias. Since you know the last and final point in which price should not pass, your stop loss is very small relative to the take profit. Although extreme order blocks can come in various forms, I will only be showing bullish and bearish structure examples. And I guess I could add accumulation distribution. I guess I just didn't do it just yet. Bullish extreme order block. While taking a long position from an extreme bullish order block, your stop loss will be right underneath the order block and your take profit will be at the previous high. The stop loss represents the point at which the bullish analysis is wrong. If price reaches it, and the take profit represents the point in which your bullish analysis has been completed. You can see the stop loss is relatively small compared to the take profit. This, in return, is a low risk, high probability trade. In the following example, only bullish structure is shown. This concept can be applied to accumulation and reaccumulation. So I guess I could still just add these concepts, but I'm pretty sure this one's a longer section. I'm not sure why I didn't add them. But right here, bullish extreme order block, POI selection. So here, bullish extreme order block. This is a low to high. We obviously know this is our extreme order block. If you're taking trades here, your entry should obviously be in the order block, and your stop loss should be underneath it, and your take profit should be at the previous high. And the reason why these are high probability setups that have the best success rate is typically because this is typically the furthest point in price can go while still maintaining your bias. So ultimately, if you notice, if you take a trade set up here, your stop loss technically has to be all the way down here and your take profits up here. So your risk reward goes down. But the further price goes down, the smaller your stop loss is and the larger your take profit is. So the risk reward setup alone is already great. And typically, most banks, they want to buy at a cheaper price. They want to buy a discount. Also, if this is the last sell to buy, banks want to mitigate as many sell orders as possible while also making the most profit. So the deeper they go, the better closing opportunities they have for the sell positions. So for them, this is a high probability. Well, for us, it's a high probability setup because of those reasons. Does that make sense?
Yeah.
And then bearish extreme order block. While taking a short position from an extreme bearish order block, your stop loss will be right above the order block and your take profit will be at the previous low. The stop loss represents the point in which the bearish bias is wrong if price reaches it, and the take profit represents the point in which your bearish analysis has been completed. You can see the stop loss is relatively small compared to the take profit. This in return is a low risk, high probability trade. In the following example, only bearish structure shown. This concept can be applied to distribution and redistribution. Same thing, we have this high to low. This is the extreme. This has a high win rate, high success rate, and the risk reward is very good. And I know I didn't draw the examples. I'll probably have to add them. But in accumulation, price will sweep this side down on up. The extreme order block is down here. So same scenario. You take a buy down here, high success rate. If price is going to go bullish, it should respect this area, meaning your stop loss is down here, and your take profit should be up at this high, giving you a high risk reward trade with a high success rate. So this is the ultimate trading setup that you want to see. Distribution, same thing, just opposite. Sweep, sweep. Extreme up here. Take a sell right here. Your stop loss should be above this high. Take profit at this low. Really good setup. Makes sense?
Yeah.
Continuation order blocks. As stated in the extreme and continuation order blocks section, continuation order blocks have the second highest success rate. The reason for this is because if you take an entry from a continuation order block, you may be entering a position too early. The continuation order block may work in your favor, but you have to understand price can retrace further past the continuation order block before continuing in its anticipated direction. Bullish continuation order block. While taking a long position from a bullish continuation order block, your stop loss will be right underneath the order block and your take profit will be at the previous structure high. The stop loss represents the point in which the continuation order block is wrong, and the take profit represents the point in which your bullish analysis has been completed. Although the continuation order block can be invalidated, it does not mean the bullish analysis is wrong just yet. The bullish analysis is not wrong until the structure low is broken. If the continuation is the correct order block to be mitigated before creating a new structure high, you can see the stop loss is relatively smaller than the take profit. It is just not as big of a difference compared to the extreme order block scenario. Seeing this and knowing that a continuation order block may cause you to buy the market too early is what gives this setup the second highest success rate. In the following examples, only bullish structure are shown. This concept can be applied to accumulation and reaccumulation. So in bullish structure, we have a low to high. This is our continuation order block. If we take a setup here, we have to understand that price can go further, such as into the extreme order block before going higher. So this is why I say when we take a continuation order block, we could be entering just a tad bit too soon. But just because price disrespects our continuation order block does not mean our bullish analysis was wrong. The other thing too is if you notice, although this is still a good setup, if you look at the risk reward, if you were going to take an extreme setup, you see how your reward gets larger if you take the extreme.
Yeah.
So when you take an extreme order block, that is better than the continuation for that reason. Not only do you have less of a chance of getting stopped out because you're not buying too early, if anything, you're buying at the last possible moment, and also your risk relatively stays the same, but your reward goes up higher. So in turn, your risk reward goes up, making it a better trade setup. but obviously price does not always have to come to the extreme. This is why we have continuation order blocks. Make sense?
Yeah.
Same thing with bearish structure. High to a low. This is our continuation order block. Although price can respect this area, price also could disrespect to come into the extreme before dropping on lower. So we just have to keep that in mind. Same thing, just flipped. And here's some examples that I was already drew out for you, but this continuation order block can be disrespected to come into the extreme before going on higher. So this low is used as liquidity. Price gets swept and then goes on up. Same thing here. This does not work out. This is a form of liquidity. Price gets swept into the extreme before dropping on lower. So the bearish bias was still right. It's just you don't know exactly how far price will pull back. How to choose between the continuation and extreme order blocks. Overall, the extreme order blocks will always have the best choice, but a great way of deciphering between using an extreme or continuation order block will be based off of the buildup of liquidity that comes right before the order block. So here I'm going to help you decide if you should use the continuation order block or the extreme. Overall, I even think in that video we watched, the guy only uses extreme order blocks, which I think is good. That is going to have the best success rate. So it's almost like, why would you even use the continuation order block if you're going to have the most success using the extreme? Which I get that concept, but honestly, I do take continuations as well. And the reason why I take them sometime is due to liquidity, which I'll go over now. But overall, if you wanted to just use extremes, you can. But if you decide to use continuations, hopefully this helps you figure out if you want to use it. So what is a buildup? A buildup is a way of describing liquidity being created before mitigating an order block. How to spot a buildup? You can spot a buildup of liquidity by using any of the liquidity patterns in the liquidity section. Any formation and creation of liquidity can be classified as a buildup. So once again, there is no specific way of identifying a buildup of liquidity. Liquidity is liquidity. So for example, in the section where we go over liquidity, any of those examples can be used as a buildup of liquidity. Buildup into an extreme order block. Seeing the buildup and sweep of liquidity before mitigating into the order block will increase the probability of the extreme order block playing out. In other words, you will want to see some form of internal inducement before the mitigation of the extreme order block. Bullish extreme order block. While taking a long position from a extreme bullish order block, you will want to see some form of sell side liquidity being swept before tapping into the order block. In the following examples, only bullish structure is shown. This concept can be applied to accumulation or reaccumulation. So in this first example, buildup of liquidity into bullish extreme order block. Can you see how? Let me just draw it up. This is our extreme. Can you see how the sell side liquidity was swept before hitting the extreme order block?
Yeah.
So price creating liquidity is the buildup, and then price sweeps the buildup, sweeps the sell side liquidity before shooting on higher. So when I take an entry, in this case we're talking about extremes only, I need to see some form of buildup. I need to see a sweep of liquidity going into the order block. If I don't, most likely I will become the liquidity. That's why here I was telling you, if you want to take a trade setup here, as of right now, there isn't any buildup. In this case, this is the bearish example, so I need to see buy side liquidity being created and then swept. So as price went on, I was showing you, okay, now you can see price created buy side liquidity, Price swept buy side liquidity and then just barely missed his POY. If price does not do something like this, I do not want to take the trade. I need some form of build up. And here is the opposite. Just like the chart I just showed you, there's a high to a low. This is the extreme. If price just comes up into the order block, I do not want to take it. I want to see buy side liquidity, such as here. There's a liquidity. Price sweeps it into the order block and then drops. Once price sweeps liquidity and price hits my POY, that's when I want to enter. Make sense?
Yeah.
All right, cool. I think the reason why I didn't use accumulation and distribution is because there's so many examples to show, and this page will be so long. It already is long, full of examples. Another example, extreme order block. In this one, it took liquidity from internal structure within the retracement leg. This one takes internal liquidity from the continuation leg. Same thing, still takes out sell side liquidity before hitting the extreme and going on higher. Same thing with flipped, comes from the internal structure within the continuation leg. Price sweeps it, going into the extreme order block, and then goes lower. Low to high, extreme, price creates some form of sideways movement, and then price drops. And also looking at this, can you see how this looks like accumulation?
Yeah.
And then here, as I've taught you already, this is a sell to buy, which is an order block, which price can come back on down. Price can come back on down, mitigate, and then go on higher. And you can see how price creates bullish structure all within it. All within it. So sometimes this is how you were asking me if we're getting distribution, price sweeps, buy side liquidity, would I just sell? Well, I wouldn't just sell because it's distribution. I would need to look left and see if there's a POI going into it. So here, if I am only looking at this, this is accumulation. Would I buy down here? No. I'd want to see price come on up, mitigate, and then I would buy. But in this example, I'm already looking to buy at the extreme. Price creates accumulation, sweeps, sell side liquidity. Would I buy here? Yes. And if I'm buying here, once again, all these extreme order blocks, I would take it in the order block, stop loss underneath, take profit at the high, and that would be my setup. Does that make sense?
Yeah.
Same thing here, some form of distribution. Would I just sell here by itself? No. But since price is in the extreme order block that I am looking to take a sell from, would I sell here? Yes. Stop loss will be above here, take profit down here. Same thing, but just internal structure from the continuation leg. So instead of it coming from the retracement, comes from the continuation. These equal lows get used as liquidity into the order block. These equal highs get used as liquidity into the extreme order block. Make sense?
Yeah.
The next one is compression. Sometimes you will see compression going into the order block. Price will compress downwards. And what this does pretty much, it just gives this nice, wouldn't be nice, it'd be just kind of pretty much clear bearish direction. And most people, if they are only focused on this, they would want to sell. If they don't zoom out, they will get confused and they will begin to sell. And when they sell, also some people will be buying too early. So the early buyers get swept out as price goes on down, and also anybody selling gets swept out as price goes on up. So it works both ways. This is that sell side liquidity that gets swept for people buying too early, and then people trying to sell get swept out as well. Same thing but flipped. Build up with compression, price taps into the extreme, and then drops off. Make sense?
Yeah.
Build up into a continuation order block. Seeing the buildup and sweep of liquidity before mitigating into the order block will increase the probability of the continuation order block playing out. In other words, you will want to see some form of internal inducement before the mitigation of the continuation order block. So these are actually the exact same thing, but just coming from the continuation order block. From here to here, our extreme will be down here. The reason why I use this as a continuation once again, price sweeps a little bit of sell side liquidity before going on up. So this is a good continuation order block. Also, it's within discount. As price comes in here, I still need to see some form of sell side liquidity being swept. I need to see that build up before price goes into the order block. If not, most likely if price just drops on down, this low will be liquidity to come down to the extreme to go on up. High to low, this is extreme, takes out buy side liquidity before going into the continuation order block. So this one comes from the retracement leg. This one will come from the continuation from low to high. Price takes out sell side liquidity before going on up. High to low, price takes out buy side liquidity from the continuation leg before going on down. Price can also take out sell side liquidity by creating some equal lows within the retracement leg. Still takes out sell side liquidity before going on up. Takes out buy side liquidity before going on down. Takes out sell side before going up. Takes out buy side before going on down. Same thing with compression. Price compresses into the continuation order block before going on up. And price compresses into the order block before going on down. So to say it one more time, there needs to be a sweep of liquidity going into the order block. Make sense?
Yeah.
Nice. Buildup of liquidity from a bank perspective. The reason why you will want to wait for some form of buildup into a point of interest is because the banks need liquidity to fill their orders. The buildup of liquidity is just a fractal formation of accumulation or distribution on a lower time frame. Remember that accumulation is just the formation of sell side liquidity being created, then swept to drive price higher. Distribution is the formation of buy side liquidity being created, then swept to drive price lower. This is the process in which the banks need to do to fill their orders to take price in their intended direction. The reason why you will never know which order block will work, even if there is a buildup going into it, is because you do not have the order book or know the desired amounts of liquidity the banks want. Only the algorithm knows. All you can do is set yourself up for high probability setups. In the following examples, I decided to use several examples of price mitigating extreme order blocks in bullish or bearish structure. The same concept applies to continuation order blocks in accumulation slash reaccumulation and distribution or redistribution. So as I showed you previously, when you get that sweep of sell side liquidity going into the order block, it is a form of accumulation. When you get a sweep of buy side liquidity going into the bearish order block, it is a form of distribution. Do these illustrations make sense?
Yeah.
Cool. Build up a liquidity into bullish extreme order block on the higher time frame. So typically when you get a um when you get compression going into the order block, typically on a lower time frame, it is a bullish break of structure. So once price obviously sweeps and then goes up, typically it's a bullish break of structure. So here, high to low, price gets broken here. I know it's kind of high to low break of structure. So here, that's what I mean by that. get compression going into the bearish order block is typically a form of bearish break of structure. Make sense?
Yeah.
Extreme and continuation order blocks after a structural inducement. In all the previous examples, the extreme and continuation order blocks were present within structure. The internal structural inducement was the buildup of leading into the order blocks. When there is not a buildup present in these scenarios or the algorithm needs more liquidity, the banks will perform a structural inducement to seek out the external liquidity outside of the structure's range. So what I'm trying to say here, most of the time what happens if we're in bullish structure, price will seek out internal liquidity, meaning the liquidity resting within the structure. Within structure here. If you don't see liquidity being built up within internal structure, a lot of times what happens is the banks, they will seek liquidity from external structure, which they call it external liquidity. Meaning, once again, if there's not enough, they have to seek out liquidity to go on higher. So this is why sometimes price will give you a structural inducement, take out the liquidity coming from this low before going on higher. So once again, I'm in bearish structure. Say this is my extreme order block. Price could use this high as a form of liquidity to go on lower. But if that is not enough, which we don't know if it is ever enough, price could also seek out liquidity resting above this high and then go on lower. So that's the reason why structural inducements happen. If there's not enough resting within, it'll seek external liquidity. And that's why I say if price, whoops, is in bearish structure and you see this happen, this looks like a clean break of structure. But be wary because you did not see any liquidity being built up or swept. So most likely, the liquidity they're looking for is resting up here, and then they drop. So they give you that structural inducement. Does that make sense?
Yeah.
Structural inducement in bullish structure. In bullish structure, the banks may not have enough sell side liquidity within the structure's range and may seek sell side liquidity outside of the range. When this happens, you can use an extreme and continuation order block underneath as a point of interest to buy from. The structural inducement is the buildup that leads into the order block. So in this case, if I do get a structural inducement, one option you can do is take the extreme, the previous extreme order block. So this will be the first extreme that I'd be looking at. If I get a structural inducement, I will use the previous extreme order block below it. Does that make sense?
Can you repeat it again?
Sure. So this is a low to high, low to high, low to high. As price breaks this low, obviously this extreme order block is no longer valid, right? Price broke it.
Yeah.
If I believe I am getting a structural inducement and I want to enter this trade because I think price is going to do this, the way I would do that, instead of using this extreme order block, I will use the previous one right before it. So obviously it's this extreme order block. And I would enter here. And the way I see this is if this is my POI, isn't this a sweep of sell side liquidity going into my POI?
Yeah.
So if that, so in this case, if I am looking to buy here, I could use this structural inducement, which is sweeping sell side liquidity as a form of liquidity being swept into my POI. So then now this would be a good trade. Does that make sense or reword it?
Um, Wait, can you go back to that? The thing I don't get is how do you know which order block is gonna be the one to go up? Which order
Sure,
block's gonna be the one to change
sure.
everything?
Got you. So let's look at this first one, right? At before price blew through it, you would look to buy here, right?
Yeah.
Great. Was there a buildup of liquidity? Was there a sweep of sell side liquidity before hitting the order block? Did you see price do this?
No.
Correct. So if it did not sweep sell side liquidity going into the order block, would you want to buy here?
No.
Correct. So price then goes on down. There was no buildup. Now, if you believe that this is going to be a structural inducement and you think price is going to go on higher, or maybe let's say this is a breaker structure and you think price is going to do this and then drop, but you want to catch this buy move. Either way, whether you think it's a retracement or you think it's a continuation, you want to buy, correct?
Yeah.
So now, since price broke this low, this structural inducement, doesn't it take out sell side liquidity?
It does.
Correct. So if you're looking at this extreme POI, did you get a sweep of sell side liquidity before hitting your POI?
You did.
Correct. So if you did get that, then this would be a better buy position to go on up. You are still taking an extreme order block setup. You are still getting a sell side liquidity sweep going into the order block. So this is a valid buy. The only issue with this is price going to retrace and then go down because this actually was a break of structure? Or was this a real inducement to go on higher? And like I said, you will never truly know if it's a break of structure or an inducement, but you can use context clues to figure out if it is or not. Make sense?
Yeah, I get it now.
Cool. And then we'll do the bearish example. Price is going down. Extreme POY here. Price comes on up. Unless you get something like this, where price sweeps liquidity, this will be a good setup. But sometimes price won't do that. Price will just run it. So from here, you have a pretty good understanding that, okay, obviously this didn't work because there wasn't enough liquidity. Liquidity didn't even get swept at all in here. And if price is truly giving me an inducement, it has to seek out external liquidity because obviously there was none in here. So it's going to seek out the liquidity above this high. If that's the case and you are looking to sell, you can use the previous extreme order block, which is here. At this point, price swept this liquidity before tapping into this order block here. So this will be a good setup to sell to go on lower. Make sense?
Yeah.
The other example, and actually this isn't the right picture, I need to change that. The same concept applies. There's the bullish example. Price could also hit the continuation order block, resting underneath. So you see how this will be the extreme order block? Well, this was the extreme first, but this is the second one.
Yeah.
Now you see from this low to high, this is a continuation order block.
Yeah.
Then you see how this continuation order block is right underneath this low to high. So if price
Yeah.
sweeps, gives you a structural inducement, and it sweeps out sell side liquidity, instead of using the extreme order block here, you could actually use the continuation order block resting underneath. So you're using the previous structure, the previous extreme and continuation order blocks as potential POIs. Does that make sense?
Yeah.
And then this is the bearish version. This is the extreme. This is the second extreme. Price runs this high to sweep liquidity, but instead of attacking the other extreme to go on lower, it simply mitigates the continuation order block here. So this is the valid setup because price sweeps liquidity here going into the POI. So this is still a valid setup.